To recognize hidden market shifts before the big move starts, we need just one simple strategy: RSI divergence. Before we talk about divergence, let's first learn how to find and add the RSI on your chart. On TradingView, go to the top of your screen and click on Indicators. In the search bar, type RSI and select Relative Strength Index. Once you click on it, the RSI will appear automatically at the bottom of your chart as a separate window. You'll see a line moving between two levels, 0 and 100. Now, let's understand what this indicator actually shows. RSI stands for Relative Strength Index. It's a momentum indicator that measures the speed and strength of price movements. It tells you when the market is overbought or oversold. In other words, when price might be ready to reverse. When the RSI is above 70, it means the market is overbought and price could soon start moving down. When the RSI is below 30, it means the market is oversold and price could soon start moving up. So the RSI gives us a quick visual clue about when momentum is slowing down, but that's just the beginning. The real power of the RSI comes from spotting something called RSI divergence, one of the most reliable reversal signals in technical analysis. Look at your chart and compare the price highs or lows with the RSI highs or lows. If price makes higher highs, but the RSI makes lower highs, that's a bearish divergence. It means buyers are pushing the price higher, but momentum is getting weaker. A sign price could soon fall. If price makes lower lows, but the RSI makes higher lows, that's a bullish divergence. It means sellers are pushing price down, but momentum is slowing. A sign price could soon rise. Now that you know how to spot a regular RSI divergence, here's something most beginners don't realize. Divergence alone isn't enough to take a trade. Yes, divergence tells you that the trend is losing strength, but it doesn't tell you when price will actually reverse. Sometimes price keeps pushing in the same direction even after a divergence appears. Why this happens? The market often needs to grab liquidity before reversing. In other words, it hunts the stop losses of retail traders who enter too early. That's why if you buy just because you see a bullish divergence, price might still drop lower to take out your stop before going up. And if you sell just because you see a bearish divergence, price might still push a little higher, take liquidity, and then reverse. Instead of entering immediately when you see a divergence, you want to wait for confirmation, a clear sign that smart money has finished grabbing liquidity and that the reversal is real. That confirmation comes from something called a liquidity sweep, a simple but powerful concept that helps you spot where the market traps traders before making its real move. Before we combine it with RSI divergence, let's first understand what a liquidity sweep actually is. This concept is simple, but it completely changes how you see the market. So what is liquidity? Every time a trader